Hey guys, welcome back to the Financial Freedom Channel, where we make your money work hard for you. So the other day I watched a video by Graham Stephan, and he was saying every dollar that he has, he looks at as worth $5. And the reason for that is when he invests a dollar in real estate, he can leverage that dollar 5 times. So say he has $100,000, he can control a property worth $500,000 by getting a 20% loan, an 80% loan, putting 20% down and getting a loan for the rest. So it got me thinking, I've been looking at apartment building investments in Las Vegas. And so I've been thinking about the different ways to break down the returns from a multifamily investment like that. And one of the big return buckets is from rent growth. So I wanted to dig into some numbers today. So I'm gonna put an example up here. So say we've got a 32 unit apartment complex. We're gonna buy it. So the upfront cost is $9,086,800. And this is an actual deal from someone I know who they didn't actually buy it, they put an offer on it, and this is how they ran the numbers. So that's the cost. Loan, $6.6 million. Okay. The equity or the down payment, $2,486,800. Okay. So 32 unit, this is what it cost. A little over $9 million, loan for $6.6 million. And so that is what was required up front from the investors, the down payment from the investors. Now a couple more numbers. The debt. So the annual debt payment is $425,163. Okay. The annual operating expenses. The op expenses, $179,000. Okay, and of the 32 units, the average rent in the first year is $2,000 per month per unit. So I want to go through some numbers here. Assuming we can grow rents at 5% per year, how do the numbers shake out from the rent growth? What are our returns as investors from a 5% rent growth? And just so you guys know, 5% is actually a fairly accurate number for Las Vegas right now. Looking back the last year, there's been a 5.2% rent growth over the last year. It's projected at around 4.8% for the next year. So we're hovering right around 5%. This isn't like a crazy number. This is actually what we're seeing in Vegas. Okay, so let's go through some numbers. So we got year 0. Okay, we just bought the property. Rents are $2,000 a month. So the total income from rents are $725,760. Okay, that's $2,000 a month times 32 units times 12 months in a year times 94.5% occupancy rate. So there's a 5.5% vacancy rate in Las Vegas. So we've got to factor that in. So this is the gross income from rents, okay? Now, if we take off our operating expenses, here are annual operating expenses. This is for property taxes, insurance, maintenance, property management, all of the expenses associated with owning this property. We're looking at $546,760. Okay. Now we subtract the debt. So our annual mortgage payment, we're going to pay $425,000, a little over $425,000 per year. So if we do that, then we get down to $121,597. Okay, so that's the cash coming in, guys. This is our cash flow. So in the first year, that's what we make as investors. You know, the annual, the gross income from rents minus operating expenses minus debt service. That's our cash. So if we're looking at our cash on cash return, we want this cash coming in after everything has been paid divided by what we put up front. Okay, so that cash on cash return is 4.9%. Cash on cash. Okay. One more thing I want to do here. So this is the NOI. Okay, net operating income. So that's the gross income minus the operating expenses. Net operating income. Now the reason net operating income is important is because if we know what the net operating income is, and we know what the cap rate is in Las Vegas, then we know what we could sell the property for. Okay? So the cap rate associated with this property happens to be 5.8%. Okay? And what that is NOI, essentially over purchase price. Or sale price. This is what the property is worth, given this cap rate, given this net operating income. So if we do that, if we take this NOI, 546,760, with the 5.8 cap rate, we can get basically what the value of the property is. And that is $9.43 million. Okay. And we're taking NOI divided by 0.058 in order to get this number. Okay, so that's year zero. So if we look at year one, if we increase our rents 5%, instead of $2,000 a month, we're going to be collecting $2,100 a month. Okay. Now, if we do that, keeping vacancy the same, so there's a 5.5% vacancy. Our gross income from rents is $762,048. Okay, that brings us down to an NOI of $583,048. Okay, brings us down to a cash flow of $157,885. Okay, so these numbers are the same operating expenses, same mortgage payment. That's going to give us a cash on cash return of 6.3%. Okay, and the value, now that our operating income has gone up, what is that, $38,000 approximately? We've got $10.05 million. Okay, so we just went up, what is that, 620,000. So the value is worth $620,000 more because we increased the rent by 5%. So let's jump ahead, all right? Let's jump ahead to year 5, okay? So we've increased rents 5% for 5 straight years, okay? Now rents, instead of $2,000, instead of $2,100, they're $2,553 a month, okay? So let's see what our numbers are here. We've got gross income from rents at $926,274. We've got net operating income of $747,274. We've got cash coming in $322,111. Okay. Now this cash flow coming in, if we look at the cash flow coming in divided by what we put down, that's a 13% cash on cash return. So we went from about 5% cash on cash return to 13% in 5 years, just by increasing rents 5% each year. Okay. What gets really interesting here is the value of the property based on the NOI and the cap rate, and that's going to be $12.88 million. Okay. So just by raising rents 5% each year for 5 years, we went from having essentially from a property that's worth $9.43 million to a property that's worth $12.88 million. So we gained $3,450,000 just from raising rents 5% a year for 5 years. So you see, we more than doubled our money in 5 years just from raising rents. Now, you know, if we include, we're paying down principal on the loan each year for 5 years. You know, I think the interest, you know, on a 5% loan, the interest is $330,000. So we're almost paying $100,000 down each year. And actually, the total pay down from the loan over 5 years is $608,000. Okay. Now, if we just look at the loan pay down and the increase in value from raising the rents 5% a year, I mean, this is plus 4 million. What is that? 4,058,000. So we're putting down about 2.5 million. 5 years later, we've increased that from 2.5 million to about 6.5 million. That's an annual rate of return of 21%. And this is just from raising rents. This is just from the value of the property by raising rents. Okay? The value of the property and the increased equity we have because the loan principal has been being paid down. You know, this doesn't even include the cash flow that we're collecting every year. I mean, if you include the cash flow every year, that's another 9%. Okay? we're essentially we're taking the average of these cash on cash returns. You see first and second year, you're missing a bunch here, and then we're up to 13. So if you include the cash flow, that's another 9% annual, right? So we're looking at 30% annualized returns from the cash flow, from increasing rent 5% every year, and from paying down the loan. 30% annual returns. I'm not even talking about, what am I not talking about? Loan pay down. I'm not talking about tax benefits. There's nothing in here about tax benefits. I'm going to cover that in a separate video. But guys, this is a pretty compelling picture right here. This is why I'm so excited about multifamily apartment investing. And this says nothing of, if when I buy the property, I rehab the units. So maybe I put $5,000, $10,000 into each unit so that, get higher quality finishes, put some wood floors in, maybe some stainless steel appliances. Maybe I can bump the rents up another $100, $200 a month. Like, that just piles on to these return numbers if I can do that. So there's just so much potential in these multifamily apartments. So, thanks for being here watching. This really helps me learn by being able to teach it and just going through the numbers. So, thanks again for being here, guys. Let me know if you have any questions by leaving a comment, and I will see you next time.